Welcome back. Please open your Excel file. This is Project Flow. It's actually a real deal that we worked on. To start, go to the tab on the far left, Normalizing Earnings. See the Notes section. Can you guess where we add to and where we deduct? Now take a look at the 2018 EBITDA of 1567. Well, here are the adjustments. First of all, the CEO was underpaid, so we deduct $125K. Then the lease was overpaid, so we add back $50K. And finally, there was a personal car, so we add back another $10K. As a result, the adjusted EBITDA goes down to 1502. Are you still with me? So move to the tab to the right, Basic IRR Calculations. Look at the assumptions. The devil's always in the detail. It's fairly simple to calculate out an IRR, but it all depends on what assumptions you use to come to those projections. So here's the calculation. Look at cell B10. The purchase price is 8168. That's 5.5 times trailing EBITDA. And then the free cash flow for 2019 is EBITDA minus taxes, which equals after-tax cash flow. Here, there's no CapEx and no interest. The sale price is on G11. That's 13,155, which again is 5.5 times EBITDA, but it's 2023 EBITDA. So we don't really see any valuation compression or valuation increase. We chose 5.5 times because it's the average valuation for a firm this size, adjusted for growth, profits, and cyclicality. But really, valuation is whatever the market will bear. It results in an IRR of 26%. So, not a bad deal. Let's see what happens when we add a little bit of leverage. So go to the next tab, IRR with leverage. So how much debt can a company take? Usually, we're looking at 4 to 5 times EBITDA. In the current environment, maybe the low end of that scale. For this current example, we're talking about 80% of the purchase price. So now take a look at B10. You can see that there's a massive reduction in the cash outlay, which of course leads to a substantial increase in the IRR. It's now 83% a year. Not bad. Cash flow calculation, it's similar to the basic cash flow, but here we deduct interest and there's less taxes. So there's just one more adjustment to make, and that's for operational improvement or synergies. So take a look at line 21 of the next tab. Here we invest $900,000 to increase revenue by $2 million. We get this revenue since we're entering a new market vertical with the exact same product. So actually, it's not a very risky venture. However, we may need to adjust the amount of debt we can take because there's less cash flow early on. Regardless, the IRR jumps to 103% a year. So that's the wonderful world of private equity. If you have any questions or feedback, please email Dave, and I would be more than happy to respond. Have a wonderful day.